This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Claudia Sahm, she has been front and center with this mystery of a non-recession. Her work on recession in Michigan was just extraordinary years ago. She is with Sahm Consulting on this Fed Day. Claudia Sahm, I want you to talk about what you got from Claudia Goldin. The idea here that it wasn't going to be nice, we were going to play hardball, we're going to do first-order research like you did at Michigan. Tell me what Claudia Goldin meant to you.
Claudia Goldin's an absolute leader in the field of economics. She's a scholar. She's a hero to a lot of women, and frankly, men in the profession. And it comes into the real world. She's one economist that really said, hey, we got to think about women in the workforce. And we saw this year women's employment rate for prime age women hit an all-time high. Right. So it's not just about the theory and the scholarship. It's about let's make this happen in the real world.
This goes to the American mystery of a non-recession. You've provided leadership on this year. Do we misjudge women in the economy? Do we misjudge technology in the economy, which means we have to have a humility about the Sahm rule in 2024?
So we absolutely, I love that this is Fed Day, but we have overplayed what the Fed means to this economy. We need workers back, not fewer customers. The Fed can only do the latter. We have seen workers come back. We have women, we have Black men, we have people with disabilities. And to your point, productivity. I mean, this is the holy grail of prosperity. We've had some pretty good productivity numbers recently. And frankly, there are technologies in place. Like work from home did a lot to help women who were on the sidelines, or those with disabilities. So, I mean, we really have some great stuff going. We just got to keep pushing.
Claudia, you were saying that the Fed is not the end-all, be-all. So then why are you so excited for today? What are you hoping to hear from the press conference?
Oh, I love the Fed. So Fed Day is always a fun day for me. So I feel like the soft landing's in the bag for next year. 2% inflation, unemployment stays below or around 4%. And that... But my biggest risk factor outside of politics in the economic space is the Fed. And frankly, what I worry about is them confusing markets. And I'm really not fully emotionally prepared for the summary of economic projections this afternoon, because I don't think it's going to give markets clarity. They're all over the map on their cuts. There's no way we're getting first quarter cuts from the Fed. And I worry that they're going to create enough uncertainty that something breaks. We've been lucky so far. Nothing's broken. And that could come back and put the soft landing in some danger.
What would break? I mean, what we've seen is markets becoming more accommodative, a stabilization in benchmark bond yields. Where is this potential for breaking coming from on the heels of Fed communication?
Right. So if I could predict a financial breakage, I could make a lot of money. Right. These don't come in an expected way. I think Silicon Valley Bank was that was a scary moment. Right, the Fed set up an environment with interest rate risk, and then you had a bank that had made incredibly bad decisions. So that kind of came out of nowhere in a big picture sense, and yet we got it under control. The Fed stepped in, regulators stepped in. So, I have a lot of faith. Again, this is a risk that I see, and it's a pretty low risk. But we've had a pretty good run of the Fed, not things breaking in financial markets, and frankly, I'm a little surprised. I'm thankful, and I think we're on the right path. But the Fed needs to stop injecting uncertainty. They got to get the message straight.
Although it's unclear to create certainty at a time that's deeply uncertain. This is sort of the conundrum for Fed officials and for economists and even for people in the market. You were saying that next year the soft landing seems to be in the bag, but the biggest risk factor is the Fed. What is the bigger policy error that you see them committing? Would it be cutting too soon or cutting too late?
I honestly don't think the Fed matters much next year. This disinflation has not been about the Fed. Jay Powell is not landing this plane, right? This is not about the Fed. Now, one thing I would really like to see today is that Jay Powell articulate that they're going to go slowly and really get people off this first quarter Paul. Like, they're just not going to have enough data by March, and they're going to be little c conservative in cutting because they don't want to have to raise again. They don't want to make it look like politics.
Right.
It's an election year. So but there's been a lot of communication issues. Like, you've got so many FOMC officials out. Frankly, I think they should limit their airtime. Sorry. But, I think that's where there's been some confusion. But when I listen to them, I'm like, they're going to wait.
How we feel, Claudia.
You get to listen to a lot. But I think they're going to get it together.
Right.
They know what they need to do.
Claudia, out on LinkedIn today, you allude back to the Volcker fantasy, the idea of Powell being like Volcker, and you even take it back to the emotion that no one wants to be Arthur Burns. He had the pipe smoking, and what was a cloud of smoke telling us in the meeting. Tell us what we want to avoid that Arthur Burns did decades ago.
There were two things that Arthur Burns did that are at least seen as a mistake among monetary policy officials. One was whenever unemployment started to drift up, he cut. And then inflation came back even stronger. And there were a few episodes of this. And that meant when Volcker came in, there was a real mess. They had to cause a severe recession. Jay Powell has said on record that Volcker is his hero. Right. And the second thing that Burns did that actually lines up with next year is Nixon really pushed on Burns to cut those rates. There's no way they want to do that this time.
Let me channel from Jon Ferro this morning. Is Chair Yellen and Vice Chair Biden, are they pushing Powell to cut rates?
No. This White House, this is not the Nixon White House, right? They know better than that. You have the former vice chair of the Fed running NEC. You've got the chair of the Fed running the Treasury. Like, there's no way, right? They know better.
Claudia, congratulations on your impact this year. May a non-recession trail you into 2024. Dr. Sahm is with Sahm Consulting in her absolute metric of original research, the Sahm rule, front and center for so many in academic and market economics.
One of Wall Street's biggest bulls is calling for the S&P to rise nearly 13% next year to 5,200. Jon Stoltzfus of Oppenheimer writing this: we look for 2024 to be a year of transition as markets navigate what we expect will be the Fed's pivot from a restrictive monetary policy setting to an easier stance. Jon Stoltzfus, I'm pleased to say, joins us right now. Jon, I actually think your call is original in the sense that I don't think it's too dependent on rate cuts next year in quite the same way as it is elsewhere. Jon, can you just go through your framework, the path to 5,200 on the S&P?
Yeah, great to be on surveillance as always, John. The thing about this is, when we look at it, we think the traders right now are pushing this dream of 4 rate cuts next year. We think the economy is showing significant resilience in the face of 11 hikes and 3 pauses thus far, or skips as the Fed prefers to call it. The Fed has shown remarkable sensitivity as it practices its mandate to keep untoward levels of inflation in check. And so all in all, we think this looks good, as with cuts likely to happen in the second half of the year, and probably maintain mostly, if it's going to happen, probably in the fourth quarter, and then only once or twice.
John, there is a shift going on. I saw it from our Gina Martin Adams at Bloomberg Intelligence. It's obviously Stoltzfus 101. And also the great Urian Timmer, chart guy at Fidelity. There is a shift to earnings analysis. We're moving away from Fed navel gazing to OMG, look at revenues, OMG, look at earnings. We've seen this before. How does the market react?
We think the market is actually well positioned to react positively to it. It's not only about traders, it's intermediate and longer term investors and traders that create the environment. The markets are like music. It's math and emotion. It's fear, greed, and need. So some people invest for need, others invest for the short term, the fear and greed aspect. And we think it creates, I don't want to call it a cocktail because that sounds a little bit too volatile, but it creates an opportunity where if we focus on earnings in an environment where it's the end of free money, where bond issuers have to pay for the privilege of borrowing money and bond buyers get something in return, this just looks like a more normalized environment, and we like it.
Does it make you nervous that everyone seems to be agreeing with you these days?
Oh, it sure does. That's the one thing. We saw an awful lot of the bears who last year were telling us about the pending recession and the massive unemployment that was coming and all this stuff that was negative. They took the negative pitch book sold last year, and it's what we believe really caused the market to decline as it did last year, on things that were never realized. And so the bears have pivoted, but when they pivot, you get that feeling if you're on a boat, all of a sudden everybody's on your side of the boat. You start looking for a little ballast, and that might well be in terms of taking advantage of some of the diversification that fixed income offers, as well as other areas of the market, of the equity market, that have yet to participate in this rally.
So does that mean, John, that you're broadening out to small caps, to some of the less loved areas, away from just focusing on big tech?
Yeah, Lisa, we've been working with better quality small caps on an alpha basis, and in terms of on a beta basis, or using passive indexes, using the S&P 600 ETFs versus the Russell 2000 for that purpose for quite a while. It's hurt us in terms of overall performance, but it's given us stability. We can't help but notice on days when there's volatility in the market that's caused by nervous money pulling out of the large caps. Usually these days they're going into the S&P 400 mid caps or the S&P 600, or when the tide comes in and all ships are floating, they roar into the Russell 2000.
John, what's a comfortable price to earnings ratio? Right now we're at 21 SPX. Obviously there's been multiple expansion, but what's a historically comfortable PE for our viewers and listeners?
I think, Tom, when it comes to historical, you got to think the generations. I can't help but think Leon Cooperman's ratio is probably about 12, is the most 12 times. For most boomers, it's around 16. And as you get younger, the generations keep pushing that multiple up. Some of that is probably because some of them, it's just a more aggressive positioning, okay? But it also has to do with the need that I think people are beginning to realize that Social Security will not be in the same stead that it was for many decades for generations to come, and people need to invest. And it's just like real estate in New York. Back in 78, you could buy a co-op really cheap. Even today, with all the problems the city has, gosh, if you look at the prices on co-ops, at least the ask is just, you pale at looking at it when you give it a historic comparison. We think equities move higher here, so probably 21 to 22. And I'm not a gunslinger. It's just that the demand for equities, when private equity has taken so many stocks out of the market, that it creates demand that is chasing supply.
John, let's have a good rant about co-op fees another day. Love that. Jon Stoltzfus of Oppenheimer Asset Management. John, have a wonderful Christmas. It's great to catch up with you, sir.
Michael Schumacher, Global Head of Macro Strategy at Wells Fargo, joins us right now. Michael, I love your calculus illusion. We're on a down escalator or a down elevator. What does 2024 look like? Am I on the escalator or am I on the lower yield elevator?
I think you're on the escalator, so it's going to be a slow move down in yields, Tom, from our perspective. I thought it was really interesting to hear about the move since the last Fed meeting. It's been phenomenal in terms of equities, bonds, what have you. But we do think the market's a bit overdone. It's probably overdone as yields went up. We think it's overdone as yields have gone down. We like the direction. We think it makes sense. But the go slow path here is our preferred route right now.
How do you fold Jay Bryson's economics into your study? Is it a study of global weakness as the IMF structures out to 2028? Or can there be this surprise resiliency we saw at Q3 U.S.?
You can always get resiliency. There's a potential for a surprise. China's probably a decent example. Expectations are so low. Wouldn't take much for China to surprise to the upside. But I agree with Jay and his team. You think about the global backdrop economically, frankly, it's not that great. Whether it's especially Europe, Canada looks like it's either in recession or very likely to go into one pretty soon. U.S. probably lagging behind a bit, so weakening but not as fast. But it's not a a pretty picture, and yet that's really what you want from a policy standpoint. You got to take the wind out of the sails of inflation.
You said that the move is overdone, and I'm curious which move in particular. Is it the fact that we're going to get so many rate cuts next year? Is it the fact that we're going to have a strong economy that persists despite where we are in this economic cycle? Or is it that this inflation can continue at the pace that we've seen?
No, what I was talking about, Lisa, was the yield move up and then down. We think the volatility in bonds has been extraordinary and too much. So thinking about other things that are probably a bit overcooked as well. Think about market expectations for easing by pick your favorite central bank, the Fed, the ECB, Bank of Canada, whatever it might be. They seem pretty aggressive to us right now for next year. That's not to say the central banks won't get there, but the market's ahead of the policymakers. So for instance, the Fed, price to ease 45 basis points, something like that, by June of next year. It might actually do it, but the market, we think, is running too far ahead of Jay Powell and team right now. So I think that also is a bit ahead of the game and overdone.
So do you think that essentially the equity bet that the economy will remain strong is the correct one, but the idea that disinflation will come down enough to edify rate cut bets is not going to really follow through? Is that your call?
It seems to me as really an equity layman that what's going on now in risk markets is risk markets are reacting to what they think central bankers will do. So as it becomes less likely central bankers will hike, or let's assume that's off the table, ex-Japan, more likely they're going to cut pretty soon. Risk markets like that. I think it's been about that simple. Chris Harvey can give you chapter and verse, but to me that seems to be the picture right now.
Mike Schumacher, part of this is just folding in what the dollar would do. John mentioned euro earlier. Wells Fargo's done some great work on euro, and all of this comes back to just the assumption of weaker dollar. I don't want to make theater out of it, but just an ebbing dollar, if you will. Is that your call?
Dollar probably weakens somewhat, Tom, but I think there's a consensus view out there, and we disagree with it, that the dollar falls out of bed. And the basic thesis behind that argument is, hey, the Fed's hiked a lot, the Fed's got the highest policy rate, therefore the Fed will cut the most, dollar weakens. Well, okay, but it's really all driven by the idea the Fed goes first. Why should the Fed go first? Why shouldn't the ECB lead the way, or maybe the Bank of Canada? So we think that view, the dollar really, I wouldn't say collapses, but takes a big hit. We think it's off base. A bit of weakness, yes, but massive weakness, no. We don't think that's on tap.
Let's play that game. Just priced in a lot of rate cuts over at the Bank of England. Growth not great. Mike, who do you think goes first?
So let's say the candidates, John, are Fed, Bank of Canada, ECB, BOE. I'll put the ECB in first place, Bank of Canada second. BOE is kind of a strange one to handicap. Fed's probably third, BOE fourth.
Is that a growth call or a disinflation call?
No, it's the inflation comfort level call, I guess I would call it. So how certain are you as a policymaker, whether it's Andrew Bailey, Jay Powell, whomever, that inflation's not just down, but it's actually out? That, to me, is what's going to dictate the path.
Hey, Mike, you're one of the best. Thank you, sir. And enjoy the holidays. Happy Christmas. Always great to catch up. Mike Schumacher there of Wells Fargo.
Our stress is to get the right person to talk to. Christopher McGratty is with KBW. They are the institutional investor mid-cap bank. Do you look at JP Morgan at all, or do you just ignore Fortress Diamond?
No, you have to look at it. You have to look at it as a bellwether for the industry, absolutely.
But it's like mid-cap. So I want to go to Tacoma, Washington, one of the banks you follow. I don't even know where Tacoma is on the map. Tacoma, 98403, Columbia Banking System. Where are they going to be in a year? Where are the mid-caps like Columbia Banking going to be in 5 years?
Right. I think consolidation is part of the question, Tom. Columbia is a bank that's doubled in size over the past 2 years, and so we think scale is really important in this industry. We've done a lot of work, and there's a really strong correlation between the size of your bank and the degree of profitability, and importantly, the market rewards scale. They also punish scale, and I think regulation is one of the things that we have to deal with out of the COVID.
Have you been surprised by how little consolidation we've seen between the stress of spring and now?
No, I think it's an evolution, right? The spring was forced consolidation. It was failures. We saw 3 or 4 notable failures. But as the industry picks up the pieces from March, and that is happening, we will see consolidation. The industry still has 4,000 banks. That's the only developed country in the world that has this level of fragmentation, and I think one of the consequences of failures and stress is that we need to pick up the pieces and move forward.
What's the right number of banks?
Fewer, but I think what's important about the number of banks is we need more competition for the top 3 or 4. Right, the biggest banks are the most regulated in the world, but there's really a general hesitation by the regulators to let the bigger banks get bigger. So the regionals, the 100 billions, the 200 billions, they need to be bigger to compete more effectively with the JP Morgans of the world, the Wells Fargos of the world. We think once the rules are written on regulation, and there's a lot of pushback on regulation, that is an opportunity over the next several years.
Where is the growth going to come from? Is it going to come from deposits? Is it going to come from consumer lending? Is it going to come from some of the areas where they suddenly have some real competition from private credit and private equity firms?
I think near term there isn't going to be a lot of growth. Just to be very candid, I think the banks are deleveraging. If you go back to the financial crisis, they had credit first and deleveraging second. This cycle, we are deleveraging. We are shrinking balance sheets. We are raising capital and liquidity. And I think going forward, that's going to be a challenge for the next 1 to 2 years.
David Conrad, your shop covers the larger regionals like PNC Financial and all they do for the Pittsburgh Pirates. Great. When do they finally merge to compete with the major banks? I mean, it's ridiculous. We used to have 5, 6, 7 major banks. Now we've got 4 with an asterisk. That's called Citigroup. Okay, but we got to get more major banks. When do the PNCs get to play?
I think we need to know what the rules are going to be. Basel III is a big development that's being debated right now. I think near term, with the credit uncertainty in the economy, I think pencils are down for M&A. But I think over time there will be more consolidation.
Think about what you just said. We got to get more major banks. Does anyone in Washington agree with Tom?
No.
Not right now, no.
So why would that be the direction of travel anytime soon?
Because every other nation's done this. You mentioned it.
I'm with you.
You knew it.
Totally get that.
This goes back to
I get
Andrew.
that.
This is Wendy Schiller territory.
But we have to figure out why we're sitting here in this sole, lonely, developed nation with 4,000 banks. We're here because someone wants us to be here, right?
But regulation changes, right? So for 2008, global financial crisis, the $50 billion systemic level was put a line in the sand. That was walked back in 2016 after the Trump administration. So without getting political, there is an element of political consideration that you have to think about.
I mean, I just remember, John, being in London as a paperback writer was just released by the Beatles. I'm walking around, there's no banks. I mean, I remember looking around compared to America. There's a bank in America on every corner, and that's not true.
Well, you're bringing up a different conversation. The footprint on the high street, on Main Street in the UK has changed massively. We've seen a lot of closures. I don't see that in quite the same way here in the States. Why is that?
The branch closures. You're seeing smaller and fewer, but certainly there's a lot of regulation you have to also pay attention to. Fair lending, making sure a bank has exposure in certain pockets of the economy in different markets.
What's the advantage to having strong regional banks? I mean, with all due respect, there's this question of whether banks have been saved again and again, particularly on the smaller end, who didn't hedge appropriately when it came to some of their interest rate exposure, who invested in a lot of commercial real estate that was faulty. And a lot of those activities in terms of consumer loans are moving to other investment firms. What's the argument for beefing up this industry in a more material way?
The smaller banks are the lifeblood of the economy. JP Morgan, great company, Citigroup, Wells Fargo, big, powerful institutions. But at the local level, you do need the local small bank to give that customer service. Now, you're right. A lot of mistakes were made with interest rate risk and interest rate management, and those shareholders and those companies certainly paid the ultimate price. But I think for a healthy and thriving economy, you do need more scale and size across the gamut.
If you took the three of us. We haven't been in a branch since I think the Red Sox were in first place.
Speak for yourself.
I'm going to say the same thing.
We do everything digitally, Zelle this, Zelle that, all the rest of it. In our banking, how does Columbia Savings Bank, Tacoma, Washington, compete with the digital investment of the major banks? I just don't understand that.
Right. The smaller banks are certainly 1A. The bigger banks are going to move first. The small banks are going to adapt second. But certainly they have built out capabilities, these smaller banks, to compete effectively. Maybe not to the sophistication of an international bank.
Give us an example of that. What's a capability they have in Tacoma, Washington, where they don't want Brian Moynihan to come in from Bank of America?
So I would say turnaround and online speed for deposit captures. Right, we can go and deposit money without going into a branch. I haven't been to a branch either in years. And certainly,
Thomas Schode goes in every day. Be careful what you say. President of KBW.
We do. But I mean, the capabilities for you and I as a consumer, certainly the smaller banks can accommodate that. Maybe they're not going to have the budget initially, but they will follow.
This is a really hard rally off the lows for the regionals. We're still down about 25% from the highs of the year. Mm-hmm. Any reason to believe we reclaim those highs next year?
Right, we're still market weight, the U.S. banks. We moved, this is the 1 year anniversary of moving to market weight. And what we've seen over the past 12 months is a 30-point divergence between the S&P and the banks. And so the first part of the year, the spring, was really about net interest margin, net interest income, deposit flows, and systemic risk. That leg of the relay race has largely played out, and that's stabilized. What we're feeling now is, what is credit going to look like as interest rates have risen? How much of a credit normalization process are we going to go through, and how much will this weigh on earnings estimates going forward? The key for us is the direction of earnings dictate the direction of the stocks.
Not just the direction of the 10-year yield.
Now, the last 3 months has definitely been a trade on the 10-year.
It's been amazing, Lisa. All of it, pretty much off the back of this move in the bond market.
And completely counterintuitive, because usually higher rates were good for banks, and now lower rates going down pretty rapidly are better for banks. This is default risk. This is concern about withdrawals of consumer deposits. This is concern about breaking the system. If that's taken off the table, people can get perhaps a bit more opportunistic.
In 20 seconds, any reason for that to change anytime soon, the correlation between bonds and regionals?
I think the question of why rates are coming down, are rates coming down because inflation's moderating, or is it because growth is slowing? Your prior guest talked about that. If we get a softish landing, which KBW is in the camp of softish, I think the banks can work, but I think if it's because we see something break in the system, and I think the futures market 100 basis points a little ahead of itself. Yeah. But if credit's the big wild card.
They were the things breaking earlier this year. Chris, it's good to see you.
We're going to digress here for a little minute, because some of my heritage goes way back to Thanksgiving. The world stopped.
Yep.
And A&M, with the Corps Cadets standing, freezing, would play a small team from Austin and lose. That was always the case. And the world has moved on to the fighting Texas Aggies, now one of the great universities of America. And before we talk the airline business here on Southwest Airlines and their CEO, Bob Jordan, we're going to talk to him about how College Station has changed from when my father went there 70 years ago. Tell us about the new College Station.
Oh, it's changed considerably, and I'll have you know, we did not lose every Thanksgiving. That was uncalled for. But no, it's really changed. A&M, when I was there, was probably 30,000 students. We are now the largest university in the country. 25,000 students in engineering, as an example.
In oceanography. They reinvented it.
We don't have 25,000 in oceanography, but we do have 25,000 in engineering. But no, fabulous place. And we just named a new president, General Mark Welsh, yesterday, and he will do a fabulous job.
Honored to have with us Jess Menton today, fighting Texas Aggie as well, usually doing equities with us, but with Bob Jordan of Southwest Airlines. The airline business, I don't get. I was looking at what I was paying for a year ago, 18 months ago. How do you manage the new capacity and the fare declines we're all celebrating?
You know, the Southwest is born out of low cost that produced low fares. Southwest Airlines created the low fare industry and really gave Americans the freedom to fly. And fares are up, but if you go back to pre-pandemic, fares are only up about 8%. From 2019. So while they're up, they have absolutely not risen with inflation. And our goal, as always, is to keep costs low and keep fares low.
So, Bob, talk to us about we know the holiday. We're hearing from a lot of from you, your earnings you reported, and from some of your peers. Holiday travel's strong. How about post-holiday travel? That now investors are starting to ask about post-holiday travel. What are you seeing in terms of demand, fares, that type of thing?
Yeah, the holiday bookings are really strong, especially close in, November, December. In fact, we've got an 8K out this morning that is revising our guidance and revenue to the better end of the range. I'm very proud of that. The travel demand is different. It's really driven by the fact that, for the most part, business is strong. Leisure is strong, but business travel is not restored to 2019 pre-pandemic. And so we're all adapting our schedules to deal with that. In the first quarter, for example, we took out some capacity, and it's really about drawing down Tuesdays and Wednesdays because those are the days where you're just missing business travel that was there. But I have confidence that business will recover. We're seeing sequential improvements quarter to quarter to quarter. But no, bookings are strong, both on the leisure and the business side.
She's lived the Texas boom. Just met and jump in here.
Well, there's so much debate about whether or not we're headed for an impending recession, but you look at the consumer spending data, still very resilient. From your point of view as the CEO of one of the major airlines, where do you see things headed, and are we headed toward a recession or not?
It is so hard to predict. And there's been a call for a soft landing, a no landing, a hard landing for nearly a year now.
Yeah.
And as we look forward, bookings are strong, and again on the business and the leisure side, again travel is different. So we've actually modified our 2024 capacity. We've taken a little capacity out. We'll grow 6 to 8% next year, and it's really to reflect the network to the new demand trends. This morning, we also announced that our longer-term growth plans, 2025 and forward, we moderated those from mid-single-digit growth each year to low to mid-single-digit. That's really a reflection of that. And second, it gives us a chance with a little bit lower capacity to manage our CapEx and really make a push to hit shareholder returns. Our goals are to have returns that exceed our weighted average cost of capital, and we will not stop until we get there, well above, in fact.
Bob, talk to us about your fleet. Boeing 737, backbone of your fleet. How's Boeing doing in delivering what they're contracted to deliver to you guys?
Boeing's a fantastic partner, always have been. We've been with Boeing since the very beginning in 1971, and they dealt with supply chain issues like we all have. They are, in my mind, in really good shape. We have a new Boeing order that we put in place recently. It flows out aircraft very evenly, allows for very even capacity growth, about 90 aircraft a year, very cost-effective aircraft purchases. But no, Boeing's been a very good partner, and it has really gotten their delivery house in shape, in my mind. Now, we need the MAX 7, which is not certified yet. Boeing, I think their latest guidance is January of next year. It's a little smaller than the MAX 8, and we have some routes that we've got the larger aircraft on, really could use the MAX 7. But I've got a lot of confidence that Boeing's going to get that done and get that done soon.
I got two more questions, and I think one of them is your best practice to say no to all the people around you who are going, we've got to fly to London, or, the romance of Delta, United, all the bigger airlines as well, and you have to have a discipline among people that desire for Southwest to do something different. How do you respond to those endless requests?
Southwest history is to manage ourselves and manage ourselves well. We've got a very strong balance sheet. Yeah. We have a net cash above debt. Herb always said he planned for 10 of the next 2 recessions. But we manage ourselves well. We have a lot of domestic opportunities. We have the best domestic network in the U.S.
Give me a city you're not covering now where you say, we got to go there.
I'm not going to give you a city. I'm just telling you.
Some news.
Because I'll hear from them tomorrow. Okay. But we always have, I'll tell you, we always have a list of 50 or so in front of us. During the pandemic, I'm sure you know this, we added 18 new cities. We grew the network during the pandemic. We did not shrink the network. And those cities are performing. We also grew our Hawaii franchise. And we will have continued steady growth. That includes new city openings. But our focus for 2024 really is to optimize the network for the new travel patterns, because it helps us get to returns faster, returns that exceed our weighted average cost of capital.
My focus is someday I will get to College Station, Texas, to go to the Hullabaloo Diner. I mean, that's what you gotta. I mean, it's a New York diner, folks, that a million years ago, before Southwest existed, was transported by, I don't know, storks or whatever. Have you been there, college?
I have, but I've got to tell you, where you really need to go is the Dixie Chicken.
Well, I agree.
I mean,
I agree with that.
You want to chime in here, Jess?
Nice cold beer, best burger ever.
It's the best burger. You can have fries, chicken wings, all of that good stuff.
Right.
But the beer, of course, Shiner Bock.
my
can't miss that.
fondest hope, and
Paul's
Michael
can't
Barr,
wait to go.
I'm going.
Michael Barr's not here now, arch Detroit Lions fan, but my fondest hope is that you get Texas A&M, University of Texas football back Thanksgiving morning at 10 a.m. That would be my
we play
fondest hope.
next November 30th. It's a Saturday.
Are you going, Bob?
It's not back to Thanksgiving, but we'll work to get it there. Am I going?
We should all go together, the four of us. Paul can't
Listen
wait.
to you, making plans. Jess Benton in charge of our day killer. Bob Jordan, Southwest Airline. He is from College Station. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.